Welcome, market participants, to another Three Things in Credit. I'm Van Hesser, Chief Market Strategist at KBRA. Each week, we bring you three things impacting credit markets that we think you should know about. We are a week past the U.S. jobs report, and out of the usual avalanche of analysis, this bit, for me, stood out. Robert Armstrong, who pens the unhedged column for the FT, provided a summary of the last 10 U.S. employment reports. Bad, good, quite bad, quite good, very bad, very good, very bad, very good. All the while, the unemployment rate bobbed around between 4.1 and 4.5%, with the latest result landing right between the two bookends. We are often puzzled by characterizations of the jobs report as the gold standard of data. As a recovering corporates analyst, I just don't get it. The monthly revisions are breathtaking, and don't get me started on the BLS's annual benchmark revisions. This week, our three things are: 1. Resiliency. The U.S. economy has demonstrated that in spades. But is it sustainable? 2. Dimon on credit, getting past the headlines. And 3. Consumer trends. We identify 3 flying under the radar. All right, let's dig a bit deeper. Resiliency. The ability to withstand or recover from difficulties. The U.S. economy has proven to have that. We often show a chart that shows the U.S.'s longest economic expansions, and the current one, the longest on record, is about to cross 17 years if we exclude March and April of 2020 at the outbreak of COVID. That's nearly double the next longest, which was 1991 to 2001. The current run has proven to be resilient. Consider this. In just the past 6 years, the economy has powered through a global pandemic, the highest inflation in 40 years, 550 basis points in rate hikes, the second, third, and fourth largest bank failures, heightened geopolitical tension, 2 hot wars, several energy shocks, and the highest tariffs in 100 years. And through it all, the U.S. economy continued to grow, 17% in real terms from Q3 2020 to Q4 2025, while stocks grew at an annual rate of 16%. So how did this happen? Well, we identified 3 drivers of growth. 1, the highly productive public-private partnership between the federal government and our research universities that spur and fund innovation. 2, the world's most effective capital markets. Decentralized and markets-based, the U.S. financial system does 2 things really well. It funnels capital to its most productive use. From angel capital to the most conservative long-term investment, the financial system efficiently gathers investors across the risk spectrum. The second thing the system does is creative destruction. It starves businesses with deficient business models and/or capital structures, ridding the economy of damaging zombie companies. The third driver of growth? Debt. Public debt. 2 bailouts, the GFC and COVID, have shot debt to GDP up to levels 100% that get you on the bond vigilante radar. The point of all this is that the fiscal stimulus and monetary easing now have brakes. Could it be continued? Well, in moderation, sure. We're seeing that in the One Big Beautiful Bill stimulus. And further easing would take place if the U.S. were to suffer a growth shock, which, by the way, is not our forecast. But what fueled a lot of that growth over the past 17 years has been debt, a lot of debt. Modeling out growth without that brings about a very different, more sobering outcome, something to think about for the future. All right, on to our second thing, Dimon on private credit. So the CEO of the largest American bank published his latest letter to shareholders, which, of course, far exceeds what his professional peers produce. This year, Mr. Dimon used 48 pages to capture his views on all sorts of things his bank touches. We find it fascinating to compare headlines reporting on his letter. Take private credit, for example. Axios says Mr. Dimon says, quote, private credit fears overblown, unquote. The Wall Street Journal says, quote, Jamie Dimon warns on private credit, unquote. And the FT says Jamie Dimon warns private credit losses will be larger than feared. So what did he actually say? Well, he acknowledged that 1.8 trillion of private credit is not all that large in the context of select private sector non-bank borrowing. He cites $29 billion in that bucket, including high yield, leverage loans, investment grade bonds, which includes ABS, and resi mortgages. In the grand scheme of things, he says, private credit probably does not present a systemic risk. He does go on to say that losses on all leverage lending will be higher than expected. Why is that important? Because it recognizes something we've talked about often. Private credit is not something new invented by the street, it's been around forever. Bond investors of a certain vintage, we know who you are, will recall a time when private credit lenders, General Electric Capital, CIT, Heller, Finova, Comdisco, were among the largest borrowers in the public credit markets. Eventually, leverage lending, in terms of its position in the financial system, was de risked post the GFC by relocating from market sensitive short funders, such as banks and the GECCs of the world, to a more diffuse and more prudently funded long term holders. And we often show that the relative prevalence of leverage lending as a percentage of total corporate lending and as a percentage of GDP has not changed in the past 10 years. And yes, in the great scheme of things, private credit does not pose a systemic risk, in our opinion. On Mr. Diamond's expectation that losses will be higher than expected, well, that all depends on the credit cycle, which he reminds in his letter that a downturn in said cycle will happen one day. Well, nothing controversial about that. But what is interesting is that we haven't had one of those, that is, a traditional turn in the credit cycle, in nearly 17 years and counting. What we have had, and something worth contemplating, is a series of rolling mini recessions in specific sectors. Think energy in 2014 and 15, retailing in 2017 and 18, COVID, and now maybe software. Credit crunch happens when there is a shock that lasts, causing asset values to decline and liquidity to provide new credit dries up. The turn is exacerbated by any underwriting in the years leading up to the shock that is out of step with the changed environment. Now, given all of the capital that has flowed into private credit, it's not unreasonable to believe losses could be higher than what was expected several years ago. But how much higher? The good news is that the economy is on relatively sound footing, which means that leverage lending underwriters can and have tightened underwriting standards and have moved to address deteriorating credits. That means leverage lending losses will bleed out over time, just as they always have. And for what we see economically, that makes the loss recognition manageable in the aggregate. All right, on to our third thing, consumer trends. The U.S. consumer remains steadfast in its ability to drive U.S. economic growth. Sure, evidence of the K shape is out there, and it's intuitive. The ownership class has participated fully in the up and to the right trajectory of housing and investment markets over the past, you got it, 17 years. But three things recently have caught our eye. One, the savings rate has fallen well below historic average. Two, the labor participation rate has fallen well below its historic average. And three, population growth has fallen, you guessed it, well below its historic average. The savings rate over the past 30 years, taking out the distorting COVID years, has averaged 5.3%. Today, it's at 4.5%. One narrative that makes sense is that consumers who got used to an elevated level of spend during COVID have had to eat into savings in order to maintain that level of spend as wage growth has slowed. You can make the case that for all the talk about the rise in productivity driving growth in a jobless boom, some of that growth just might be driven by a drawdown in savings. Over on the jobs front, the labor participation rate has skidded to its lowest level since the 1970s. There are lots of structural reasons why the LFP has fallen since its peak in 2000, but what's more troubling is that it has fallen steadily since year end 2023. The good news is that prime age worker participation, that's ages 25 to 54, is just off of all time highs. But the aging population is creating its own set of economic challenges and burdens, something that is unlikely to change anytime soon. And finally, the Fed is out this week with a paper that highlights unprecedented weak growth in the labor force driven by weak population growth. That means, the authors warn, that economic growth will need to come entirely from productivity growth. Since 1960, the population has grown by 1.3% on average. In 2026, what the Fed calls a precipitous drop in net international migration may cause population growth to be the weakest it's been since 1951. It's coming in at 0.4%. Historically, economic growth, which has averaged 3% over the past 65 years, has been driven half by productivity gains and half by population and labor growth. Take away the contribution of population growth, and you're left with, call it 1.5% in GDP growth. So add it all up, and you've got economic headwinds, much of which is flying, we think, under the radar. Near term from a rundown in savings, and longer term from near zero population growth. Bitter food for thought. So there you have it. 3 things in credit. 1, resiliency. Rising debt has played a big part. What if it can't be repeated? 2, Dimon on credit. We welcome the context beyond the soundbite. And 3, consumer trends. Popping up on our radar are some unsettling trends. As always, thanks for joining. Don't forget to check in on kbra.com for our ratings reports and our latest research. We'll see you next week.